All right, let's jump right into a question that seems super simple, but honestly, getting it right is the secret key to modern business strategy. What is the real goal of a company?
Robert Kiyosaki once said that for anyone who wants to get rich, finance and accounting might be the most important subject to study. And you know what? He was spot on. Not just for us as individuals, but for entire companies. Because buried in all those numbers is the one principle that really separates the winners from the losers, understanding what you're actually trying to achieve.
So what's the big secret here? What is this most important subject all about? Well, it all comes down to defining the one true north for a business. And as we're about to see, for a very, very long time, pretty much everyone had it completely wrong.
Okay, I want you to really think about this for a second. If you had to boil down everything a company does, the marketing, the sales, the innovation, into a single ultimate goal, what would it be?
For ages, the answer felt like a no-brainer. Economists, business schools, everyone taught the same thing. The goal is profit maximization. Simple, right? Make as much money as possible. End of story. And it became this piece of common sense that nobody really questioned.
But here's the thing. That super simple answer, it's a myth. And in today's world, just chasing profit isn't just a little bit off. It can be downright dangerous for a business. So, the old way of thinking, just chasing profits, is out. The new game, the modern goal, is all about maximizing firm value. Now, this might sound like we're just swapping words around, but trust me, it's not. It's a fundamental shift in thinking that changes how every single decision should get made.
So, what's so wrong with just trying to make a profit? Well, it turns out this old idea has 3 fatal flaws that make it a pretty terrible roadmap for making good decisions. Let's break them down.
First off, the word profit is just, it's super vague, right? I mean, are we talking about this quarter's profit or profits over the next 10 years? Is it net profit? Operating profit? Think about it. A manager who's told to maximize short-term profit might just slash the R&D budget. The numbers look amazing for a few months, but they might have just killed the company's future. The goal is just way too fuzzy to be useful.
Second, and this is a big one, it totally ignores the time value of money. We all know this intuitively. $1 in your hand today is worth more than the promise of $1 a year from now. But the simple goal of profit treats them like they're the same. That's a massive blind spot that makes it impossible to weigh decisions that have different timelines.
And number 3, it has absolutely no concept of risk. Imagine you have 2 projects. Both are expected to make $1 million in profit. But Project A is a sure thing, a guaranteed win. Project B, on the other hand, is a total long shot, a wild gamble. The profit maximization goal says, hey, they're the same. But any sane person knows that the guaranteed million is way more valuable.
Okay, so if the old goal is totally broken, what do we replace it with? What's the solution that actually fixes all 3 of these problems? Well, this brings us right back to the modern goal, creating and maximizing value.
So what in the world is firm value? Think of it like this. It's the total worth of all the cash a company is expected to bring in for the rest of its life. But, and this is the magic part, it's calculated in today's dollars, which means it automatically adjusts for both time and risk. And for a public company, there's a fantastic shortcut to see this, the stock price. That's why maximizing value is really the same thing as maximizing shareholder wealth.
And this is why it's so brilliant. Remember those 3 fatal flaws we talked about? Well, focusing on value solves every single one of them. It's not ambiguous. A company has one stock price, one clear target. It absolutely accounts for time because investors are always pricing in their expectations for all future earnings. And it for sure accounts for risk because investors will naturally pay less for a company they think is a risky bet. It just works.
And look, this isn't just some dusty old textbook theory. This whole shift in thinking was forged in the fire of a real-world economic crisis. And one of the most powerful examples comes from South Korea during the 1997 Asian financial crisis.
Just look at this chart. It shows this incredible pivot. Before the 97 crisis hit, a survey found that 72% of major Korean companies said their main goal was just to get bigger, grow the size of their empire. A tiny 2% cared about their stock price. Then the crisis hit, and boom, everything flipped. Suddenly, 81% of them said their primary goal was maximizing shareholder value. The takeaway here was just brutal, but crystal clear. The companies that had been chasing size and short-term gains, piling on debt and ignoring risk, they were the ones that got absolutely wiped out.
The ones who made it through were forced to adopt a relentless focus on creating real, sustainable value, just to survive.
Now, this massive shift in strategy also gave rise to a new kind of hero in the corporate world, the modern chief financial officer, the CFO. You see, the CFO wasn't just the head bean counter anymore, the person in charge of the books. They became a crucial strategic partner to the CEO. They were now in charge of how to invest the company's money, how to manage risk, and how to tell the company's value story to investors. Their job basically became the living embodiment of this new goal.
Take a look at this number, negative 1.3 times billion dollars. What could that possibly be? Well, back in 1995, that's how much market value IBM lost in a single day. And the reason? Their rockstar CFO, a guy named Jerome York, who had led a huge turnaround at the company, announced he was leaving.
And that right there, that single-day drop of over $1 billion, it just proves how much the real world, how much the market, values a leader who is laser-focused on the right goal. It's not just about the numbers, it's about the strategy of creating long-term wealth, and investors know exactly how crucial that is. So this all brings us to the final, crucial question you should ask of any business, maybe even the one you work for. Are its decisions designed to pump up a short-term number on a spreadsheet, or are they built to create real, sustainable, long-term value? Because as we've seen, the answer to that question makes all the difference in the world. Thanks for tuning in.